Hey everyone, Lauren Stamper here with Highlands Mortgage. I'm a senior loan officer for Highlands, and my passion is educating and empowering folks in the home purchase and refinance process. And today I have with me Azeb Wossen from Paramount Tax. She is a phenomenal tax strategist that I work very closely with for my self-employed clients as well as my real estate investors because she can really help optimize our situation and understands how to work the system very well that benefits you but still plays within the sandbox, of course, of what is allowed. So, Azeb, thanks for being with me today. I'm really glad to have you. And if you don't mind, by starting off, telling me a little bit about yourself and your background as it pertains to taxes.
Yes, thank you. Thank you, Lauren, for the very nice introduction. So I am one of the first franchise owner of Paramount Tax in the DFW area. So Paramount Tax is a franchise. We now have, when I joined the company, we had only like 50. Now we are over 100.
Oh my gosh.
We are located, yes, very fast grow. And we are located, we were originally, the headquarters was in Utah, but now we moved to Nevada. So we are a very big, large company. And the reason I joined Paramount Tax is because of the network, the support, the expertise that we have. So that's really one of the reasons. So at the moment, I have 2 locations, one in Plano and one in Frisco.
Wonderful. And are there any location restrictions for where your clients come from? Can it be anywhere in Texas? Can it be anywhere in the U.S.? Is it specific to Plano and Frisco residents?
No, that's just more for advertising, really, where my location is. But I do have some clients that come from different locations. So I don't necessarily ask them, what location are you coming from? So, yes, it's open. Yes.
So but you're licensed, though, to help anybody in Texas or in the U.S.?
No, we do taxes. I do taxes not just for Texas, but for the United States, for different states.
Wonderful.
We are lucky here. We don't have state tax.
Very
but
lucky.
We do have people coming from different states like California, New York, all of those places. They still have to do their state tax, so we do support them with that as well.
Perfect. Good to know, because we do have a whole lot of relocation traffic here to Texas.
Yes.
So I'm a planner by nature, so I have some ideas written down that we're going to go through. But when somebody is, the purpose of today's conversation really is about real estate investors specifically and how we can optimize their investment in real estate, not only just from growing wealth over time through natural house value appreciation, but also through income tax strategy. I think a lot of people don't realize what a big shelter real estate investing can be for your income tax payments to the IRS. So with that in mind, when is the best time for somebody who's thinking about getting into real estate investing? When's the best time for them to involve you for tax planning? Is it before they even start shopping for properties? Is it once they've purchased a property? Or is it best just to be reactive and wait till they've bought it and we know what the year looks like?
Oh, very good question. I always tell people when they're thinking about it to come and talk to us because we can offer them all kinds of help. For example, are they purchasing it for long-term rental, or is it for short-term or mid-term? So we can give them advice. And normally we give free advices, and it keeps them out of trouble, really, honestly. As far as when is the best time, it's as long as they have you approve them, they are capable of buying the rental property, but really before they close, it would be the best time to speak with us for strategy.
Okay, awesome. And when they're buying their first property, what is the most important tax planning thing that you want people to be aware of?
Yes, most of the time, people are not aware that real estate is preferred by the IRS investment because mostly when you have a small business, you are wearing both the employer-employee hat. When it comes to self-employment, you do have to pay that 15.3%. But when you are investing in real property, in rental property, there's no self-employment tax. By nature, rental properties are considered passive income, of course. What I mean by that is that if you have a loss, unfortunately, you are not allowed to offset those passive losses against active income like the W-2 or other investment type of income. But there are other ways that you can go around it.
Okay. So things that I'm aware of that you can write off against a property that you own are mortgage interest, property taxes, homeowners insurance, repairs, and whether it's like a maintenance repair or even a rehab project on the home, as well as depreciation. Are there other things in addition to those?
Yes. You
Those are the
did
big
a great
ones,
job.
but are there other ones that?
Absolutely. Like the management fee. If you don't manage it
Oh.
yourself, management fees are deductible. HOAs. If you take care of the landscaping, some landlords, they don't want the tenants to take care of their yard because they probably don't do a good job. So those expenses are also deductible. Utility expenses. If you pay for utility, some landlords
awesome.
do pay. Those are definitely. And then on the repair. Of course, repair, you have to differentiate between repair and improvements.
Okay.
So repairs are definitely tax deductible immediately, but improvements are depreciated. So if I can speak a little bit about depreciation, some people are not aware that they are allowed to depreciate. In fact, the IRS does require you to depreciate your rental properties. Most of the time for rental properties, residential, they are depreciated over 27 and a half years. No, that's normal straight line. But if it is Airbnb, normally it is over 39 years. But you can shorten that if you are what we consider like a real estate professional or an active participant. What we mean by that is if you materially participate, if you spend at least 750 hours, then you are considered materially participating. So your status changes from becoming a passive to an active. Therefore, you can now be allowed to offset those passive losses against active income.
Okay, let me try to summarize that. So
Yes.
If you're not a real estate agent, but you spend at least 750 hours a year managing the property, is that a good way to say that?
Yes.
Then you can.
Yes. So real estate professional actually it's not only agents, but it could be property management. It could be anybody that's involved in the real estate.
Okay.
But it don't have to be licensed or anything like that. You just need to you just have to materially participate 750 hours. So as an example, married couple, let's say the husband works, he has a W-2 hours, and the wife does not, or it could be the other way around. It could be the wife working, the husband not working. So in their case, let's say they're done with raising their children, they have cash available, they want to get involved in the real estate. So now the husband or the wife, now if they manage the property, they're improving the place, getting it ready to rent, then in that situation, they are considered real estate professionals.
Okay.
And they get all the benefits. So if I go back to depreciation real quick, so like I said earlier, residential is, you depreciate it over 27 and a half years. But there is such a thing, I'm sure you've heard of it, cost segregation. So what that means is that not everything in the house will last for 27 and a half years. So as an example, the floor, the appliances, the land improvements, those type of things have shorter lifespan. So for example, the flooring could be 5 years, the appliances, the land improvement, 15 years. So what normally happens is you bring in an expert to come and study your house, and they do study, and then they come back to you with a detailed depreciation schedule. So normally, land is not depreciable, of course. So land, if you take out the land, let's say, as an example, let's say $400,000 house.
Okay.
Let's say the land value is $100,000. So you do have now $300,000 for the building. So normally, about 30% of the house value, you can say you can depreciate it earlier. And
Okay.
especially with the new law that just passed in July, anything that you buy after January 19th of 2025, the bonus depreciation is back. 100% of bonus depreciation is
Oh,
back.
wow.
So that 30% of that 300,000 you can depreciate immediately. So that's a big plus right there with the rental properties, especially if you have that status or if you are what I call an active participant. What that means is that if it's income based, and if at 100,000 it starts to taper off, of course, and completely stops at 150, but you can deduct up to 25,000 deduction.
Okay.
So sorry, I got too technical.
No, it's fine. It's all helpful information, especially for people that are considering investing in real estate. This is the kind of stuff that Azeb can help you with, plan out from the beginning, just to make
Yes.
sure everything is set up exactly for optimal numbers, So I think it's super helpful. Let's see. When does it make sense for somebody who owns rentals to keep them in their own name, reporting on personal tax returns versus putting them into an LLC and reporting them on an 1120S, for instance, as a sole proprietorship?
An excellent question. So rental properties, but the reason that you want to put the rental property in an LLC is for protection. So if you have, unfortunately, somebody gets hurt, and by you putting that house into the rental property into an LLC, you contain it. So that nothing will come out of that against your personal belonging or personal property. So that's the main reason. But the rental property, one thing is you do not want to put it in S corporation.
Oh, interesting.
Yes.
Why is that?
Very good question. Number one, once you put it in an S corporation, it's a different entity. So if you decide, let's say, to move it out or something, it's taxable. All of a sudden, it becomes taxable event.
Interesting.
So the other thing is that, as you know, when people pass on their rental property or their wealth, rental properties or those investments, they get a step up. So let's say, if, unfortunately, somebody passes away, a parent, and they pass it on to the children. So when the children inherit that, let's say, California is a good example because people have bought their property a few years ago. Let's say they bought it for 100,000. Today it's 1.1 million.
Okay.
So when the child inherits, they get the step up. So that means the fair market value. So at the time of death, what was the fair market value? If that was 1.1 million, all of a sudden it's not 100,000, but it's 1.1 million. So when they decide to sell, let's say they sold it for 1.5 million, their capital gain is only 400,000, not 1.4 million.
If it's been reported on personal returns instead of an S corp, is that what you mean?
Yes. Oh, yes. I jumped around.
Okay.
S corp is because it's a share. It's so you don't get a step up. You get a step up on the shares, but not on the asset itself.
Okay.
So that's why you don't do that.
Okay.
You do not put you put it on LLC, but it's still recorded on your 1040.
Okay. Great to know. That's super helpful because I feel like a lot of people think that once you put real estate in the name of your LLC, it needs to be reported on business returns. And sometimes I think that people are doing it without knowing the why behind it or the implications for estate planning. That was a great point because part of the reason people invest in real estate is for generational wealth, having something to pass down to their kids and their kids' kids, so on and so forth. So knowing how to properly structure the tax planning piece for this real estate is crucial.
Very true, because a lot of people they create their own LLC, and without knowing, they create it and they make it an S corporation, and they put their rental property. So that's why very crucial to talk to us before they do that, which is the point you brought up earlier.
So kind of piggybacking on that, so if somebody does plan to sell a rental property that they own, some people do it just to go ahead and cash out and have access to the money in their bank. And obviously there's capital gains implications for that. But some people are looking for avenues to pick up additional rental properties. And you and I know that we can take one rental property and spin that off for down payments into multiple properties through the vehicle of a 1031 exchange. Do you have any, like, how do you feel about that? Do you feel like that's a good way for people to approach increasing their real estate portfolio?
Absolutely. Yes, 1031 exchanges are one of the ways that rich people get richer and richer because they're expanding their wealth. So it's a good way of deferring your capital gain. Although capital gain gets preferential treatment as well, it's capital gain as long as you keep it over a year. It's considered long term, and normally you pay either 0 or 15 or 20%. So that by itself, if they have to get the money, it's not bad. They do get the preferential rights treatment. But 1031 is a fantastic way of deferring that asset. But again, it's very good that for people to come and talk to us before, because a lot of people make mistake. They sell it, they get the cash in their bank, and it's too late. There are certain rules that you have to follow in order for you, if you decide to do the 1031 exchange. That money should never touch your account. There is a middleman that you work with, then there are rules.
That is a great point. So if somebody is considering selling one rental property to buy one new rental property or multiple new rental properties, before they actually start any of that transacting, they need to involve their tax planner so that we can get a 1031 attorney involved to help them do it the right way.
Correct.
Because you don't get to use a 1031 exchange if you just receive your proceeds from one sale and then go and spend that money directly on
That is correct.
one or more additional sales. You have to do it in this certain process, and it requires a 1031 specialist involved.
That is correct.
Yes.
Yes.
Yeah, I think that's something that a lot of people don't understand.
That is correct, yes. In addition to 1031, there's also, it's kind of new, but a lot of people are using it now, opportunity zone. You can put your money, the capital gain that you have, opportunity zone came in about 10 years ago. Now they're going to be the current ones right now are going to be expiring in December 2026. But that is where, low-income neighborhoods, they don't get the cash, So that's an incentive that's given. So if you can put your money, you can park not park, but invest in those areas that they are designated. You can defer it, and depending on how long you hold it, in the old way, it used to be 5 years, 7 years, or 10 years. So if you hold it for 10 years, you pretty much remove all the capital gain away, and you benefit from it. So that's another opportunity.
Is there like a zoning map online people can research for this?
Yeah, it's good to work with people. Yes, there are definitely, yes. Okay. And then it was renewed again now with the new tax law that just passed.
Oh, great.
So this one expired in 2026. Now the new ones just started in July of this year.
That's a great tip. I'm going to look that up, and I will include that link for people that are watching this video. So that led me to another thought. There's a lot of investors I talk to that are interested in, and this might be pertaining specifically to the opportunity zones, but some housing they can buy that the government is the one making the payments to them, and it's more than what they would be getting in rent from a renter.
Yes.
Is that specific to the opportunity zones, or is that separate?
No, that one I'm guessing probably Section 8 is what probably, if I understood you correctly, referring to. But no, this one is really... the government is incentivizing you for investing in those areas. Normally, people would invest in areas that they're familiar with. They don't necessarily go to areas that they're not familiar with.
Right.
But because you're given incentive, you'd consider developing that area. This is to help develop those areas that were not... that did not have the opportunity to be developed. So that's what it is.
What is the incentive specifically?
The incentive is, so let's say you sold a house, you have this $500,000 capital gain, let's say. So that capital gain, you don't want to pay tax on it, but you want to use that money to invest. You don't want it for anything else. So you put that money invested in an area that's considered an opportunity zone. So you don't pay money at all on that $500,000. So
Okay.
as long as you hold it for 10 years, so what happens is they adjust your basis at the end of 10 years. They adjust your basis by whatever that fair market value is. So that therefore you do not pay tax at all.
So it's not deferred; it's forgiven tax
If
at
you
that
hold it
point.
for 10
if
years.
you hold it for their
Yes,
timeline.
if you hold it only for 5 years, it's 10%, I believe, and then I don't think they have 7 years anymore.
Okay.
It used to be 15%. Now I think it's 5 and 10.
That's tremendous. So if we're looking for long-term investments, that's a great place to put your money.
Absolutely. Yes.
That's a great tip. Awesome. Do you have any notes for somebody who's trying to buy more than one rental property, maybe at the same time? Like maybe not one per year or something, but if they're like, I've got $200,000 to invest, I want to spread that between 3 rental properties. Does that change anything about the tax strategizing piece?
Not so much on the tax strategy, but assuming if you have 3, you're going to be full-time, you are a real estate professional, you have that status. So what I want to say is the benefit is, again, if I recall what I said earlier, real estates are passive. So what you do is, because now you are in it, so you establish a property management company that's separate from the rental properties. So instead of like paying somebody else to manage it for you, you have a third party, you have your own management company. That management company is no longer a passive company. So what happens is now they are allowed to put in money in their retirement because in order to contribute to a retirement account, it has to be earned income.
Okay.
Real estates are not considered earned, they're passive. But by you having a separate property management company that's going to be managing those 3 houses, now all of a sudden you created a different company. This is where also an S corporation might be beneficial, or a C corporation, one of those two. And then the income you can generate from that, you can now contribute to a retirement plan. So it changed, the dynamics change now. You're not just a rental property owner here anymore, but now you are also a property manager, and from that you benefited with a retirement.
Got it.
Yes.
Okay, so it's more holistic.
More holistic.
That's
yes.
wonderful. Okay, well, I peppered you with a whole bunch of questions. Do you have any questions you want to ask me?
Absolutely, of course. You play such a crucial role. So, as an example, just to follow up with just the question you asked me, if a person is capable of buying 2, 3, 4, what kind of financing option do they have?
Great question. We have lots of options, honestly. I feel like I have a loan product for everything, but specific to investors, it really depends on what they're trying to do with the property. Some people are trying to purchase and flip to sell. Some people want to update a property and hold, and some people just want to buy in decent shape property and start renting out immediately. So depending on what their goal is and what property they find, that dictates what type of loan we're looking at. But if I want to boil it down to the 2 most common investor loans, we've got traditional Fannie Mae conventional financing, and then we've got what's called DSCR financing, and that stands for debt service coverage ratio. And I'll talk through the differences real quick because it's really interesting. So on the conventional financing, this is the most traditional path and frankly the best loan terms if people qualify. Fannie Mae lets you finance up to 10 properties in your personal name at a time, so you can use this money for quite a long time. In terms of requirements, the minimum down payment is 15% on conforming loans, and the interest rate pricing is not that favorable when you're putting that little down because the risk is higher. But when you put 20 or 25% down, it gets more and more favorable the more skin in the game that you have. What's nice about the qualifying for investment properties is a lot of people don't know that you can use rental income to offset the mortgage payment. So, most people when they're trying to plan for a rental property, they're thinking I have to be able to manage my current mortgage payment plus the full house payment of another property. But from the lending side, we understand that there's going to be income from the property. So we let you use that to offset the payment. So if you're putting 15 or 20% down in terms of monthly carry costs we're adding to your debt load, it only looks like, depending on the price of the home, $200 to $400 a month extra, not the full mortgage payment. So it's really easy for a lot of people to qualify for Fannie Mae conventional financing on rental properties. When we look at self-employed individuals, as you and I both know, there's a lot of tax strategy to minimize reported income. Sure. And that's where it gets trickier on traditional financing in a lot of cases. But that's okay because there's specific loan product for those folks. So this DSCR loan I mentioned is great because it doesn't take income into account at all. What they're looking at is the projected rents on the property, the monthly rental income versus the mortgage payment. And the goal is to have a 1-to-1 coverage ratio. So if the mortgage payment's $3,000, the goal is to get $3,000 per month. That's not always the case, and that's okay. They have some tolerance as long as you're not a first-time investor. You can be below a 1-to-1 ratio. If you're a first-time investor, that's a hard and fast requirement for all of the DSCR investors. They want to make sure that the rent payment covers the mortgage payment because it mitigates risk. But yeah, there's not a limit to the number of properties you can finance if you're using DSCR financing. And there's also, in both categories, traditional conventional financing and in the DSCR world, there is the ability to roll in renovation projects into the financing. So if somebody needs, $10,000 or $15,000 to update a property that has a ton of deferred maintenance, that's okay. We can help roll that in so they're not cutting a check for it.
Wow, I don't think a lot of people know that. That's amazing. Wow.
Yes.
Thank you. What about interest rate in terms when you compare to purchasing a primary house versus rental properties? How are they deferred?
Good question. So Fannie Mae has what's called line level pricing adjustments, LLPAs, to every rate card. So that's why you see, even if we're just looking at primary homes, you see a difference in interest rates depending on your down payment, depending on your credit score. And the same thing goes for investment properties. That's riskier than primary homes for lending purposes because if you aren't able to make all your payments, you're going to prioritize your primary home over a rental property in terms of which one you could potentially let go of. So on traditional Fannie Mae conventional financing, you're looking at a difference in interest rate pricing of around 3/4, give or take. And if we're using DSCR money versus a primary home purchase, it's 1 to 1.25 difference in interest rate. So for instance, if we're in the low 6s for primary homes right now, we're in the high 6s for conventional loans on investment properties and the low 7s on DSCR money. But at the end of the day, I try to explain to people, especially our first-time investors that are curious but they're nervous, we really try to position this as, obviously, the ideal situation is monthly cash flow positive from day one, but especially in an inflated interest rate market, that can be challenging unless you have a substantial down payment. So really, we're trying to shift the focus and make them understand, instead of on a monthly basis what you're making on a property, look at it on an annual scale, because we should be taking into account house value appreciation, which in our area is very healthy in Texas in general, but specifically in the DFW market and Austin market. So we need to be taking into account how much more your home is worth than when you purchased it, as well as all of the tax shelter strategies we've been talking about when you're writing off depreciation and property taxes and insurance, repairs, rehab on the property, mortgage interest, like all those things, property management fees, all of that it helps, even though you're making the money from rental income, like you're sheltered from what you're paying taxes on, notably. So it really needs to be looked at on an annual scale, not a monthly scale. And that takes time educating people on, because naturally we look at the monthly bank account and we want to make sure that we're not paying to keep the lights on on homes we own.
Yes, yes. What about, we talked about earlier putting rental properties in an LLC. Most of the time, people purchase their homes in their own names. How difficult or how easy is it to transfer the mortgage in the name of the LLC?
Good question. So Fannie Mae does not want people, actually does not allow people to close in the name of a business at the time of purchase. However, they understand that the reason people want to have property held in an LLC is for protection, for risk mitigation, for liability.
Correct.
So they do have a path for investors to move the loan into the name of an LLC without triggering the due on sale clause. And it's a little bit of a clunky process in servicing. Your loan is held with a servicer. They have a list of things you have to go through to be able to do it, and you need to be the sole owner of your LLC. But there's a process, and I walk through clients through that all the time. They just want to make sure that the individual has a track record of making the payments on time, and then it's a pretty seamless process once you provide the paperwork required to put it into the LLC.
Wow, that's very good information because I don't think a lot of people know that.
I don't think so either.
Yes, that's very, amazing education there.
Yes, and one more note on that topic. So on a DSCR loan, there are DSCR investors that will allow you to purchase in the name of the LLC. So if that is mission critical to you as part of your strategy for the property, I can accommodate that. It just will be on different money. It won't be on Fannie Mae money.
I
So
see.
either way, you can end up in an LLC. It just depends on how you feel about the timing.
Wow. So what I'm learning is that, you're not just, helping them getting loans, but you're really advising them in which route to take that's beneficial to them. It's not. I'm not just coming to you to get just a loan, but I'm coming out with tons of advice, and I'm very well educated to make the right decision for the rental property or for any types of investment properties. That's amazing.
That's definitely the goal. And I feel like one of the value adds that I bring to the table is I appreciate and understand the value of having a team when you're starting to invest in real estate. It's not just about getting your financing in place and approval to proceed. It's about what is your tax strategy? How are you going to manage the property and rental payments and income reporting and expense reporting? How are you going to identify tenants that are going to be a good fit and take care of your property? How are you going to look for future opportunities to invest? Like, you need a great realtor, you need a property manager, you need a tax advisor, and obviously a mortgage advisor. And I feel like when you've got those pieces in place, you are really set up for success
Absolutely.
to optimize your investment. And that's the name of the game. That's why we're doing it.
That's right. That's exactly right.
Yeah.
Yes, that's amazing. I think you answered a lot of my questions here. I don't know, what else can I
I have a question for you. So
yes,
you yourself are a real estate investor.
that's right.
Is there anything that you did that as a result it's worked so well that you would recommend other people do? And it could be specific to tax, or it could be just in terms of the management of the property itself.
No, I think that is a fantastic question, because when I got into real estate rental properties, I honestly was not even thinking about it until I met you, I met Troy, I met Kent, because I was worried about, I don't have time to manage the property. I don't know how to find the house. I don't know how to get a loan. So when I saw that all of you came together, I said, this is easy. I just need to go and get approved, buy the house. Find the house, of course. That's
Right.
number one, where Troy came in. Very easy process. And it's not just find the house, but he was advising me where to look for, why I should buy there, the reasons. And then, of course, you made it so easy to get the loan from me. And then Kent, he makes it so simple. I don't think about it at all, So
You forget it's there sometimes, don't you?
absolutely. So, and then tax, of course, I do take care of the tax
Of
part.
course.
So it's like you said, it's the team. The team makes a big difference. It's a dynamic team, really, because then and then the continuous learning, the continuous conversation, it makes it so much easier to just. All you have to do is just build on that investment and expand. Just not, like you said earlier, not just rental property. It could be flipping. It could be different things. So yes, so
That's
it's so
awesome.
much to do there.
Good, cool. Well, I hope all of you took away from this some new pieces of information that you didn't know before about investing in real estate. It might feel intimidating if you've never done it before, but if you've got the right team in place, it is such an empowering process. It is very simple to follow through on, and it's easy to measure results and ROI. And as we talked about, it makes the most sense to measure ROI on an annual basis versus a monthly basis. But it's such a great place to park your money, as you said, for tax reasons and for generational wealth building for your family. So if you have any questions or you want to have a further conversation about what that could look like for you, definitely reach out. I build a team around this type of investing for a reason. They're the best at what they do, and we'd love to be a resource to you as well.